Today, my guest is Shoshana Winter. Shoshana is the managing director of intoo USA. intoo is dedicated to providing today's retail investors with access to premium commercial real estate investments. And in a minute, we're going to speak with her about investing in commercial real estate. But first, a quick reminder, if you like the show, CREPN Radio, please let us know. We would love to hear from you. You can like, share, and subscribe. And as always, leave a comment. Also, if you'd like to see how attractive our guests are, please check out our YouTube channel, Commercial Real Estate Pro Network. With that, I want to welcome my guest. Shoshana, welcome to CREPN Radio.
Thank you so much. It's so great to be here.
Well, Shoshana, I'm really looking forward to talking with you and learning more about intoo. Before we do that, if you could just take a minute and share with the listeners a little bit about your background, and we'll go from there.
Sure. Thank you so much. So as you said, I'm managing director of intoo in the U.S. We are a commercial real estate investing platform. We're based in Midtown Manhattan. We have a corporate headquarters that started the company in 2015 in Tel Aviv, Israel. And this office here that I run is our U.S. presence, and it's part of an effort that the company is making to really grow the success that we've had in other countries to the U.S. market, where we know there is the greatest opportunity and the most amount of retail investors that might be interested in what we have to offer. Just a quick word about myself. Maybe you'll be a little gentle on me. So I am new to the real estate biz. My background is I'm a marketing, advertising, and technology executive. I've worked both at early stage companies in a variety of different business types. And the reason I came here was I'm mostly fascinated by models that really change the way we behave as human beings. And I think intoo, as a platform that's really giving access to something that retail investors traditionally did not have, really fits into that category and does so in a way that I think is going to change the way we think about our money. And those are the things that really fascinate me. So I'm, as they say, drinking from the fire hose and trying to become an expert really quickly in all things commercial real estate. I'm learning more every day, and that's something that's really fun to do when you're not a youngster. and it's really been exciting, and we really are seeing some really interesting changes in the way investors are thinking about how they invest their money.
No, I think we're all here in the same place, trying to learn a little more every day. So that's you fit right in here. So let's start with, I guess, maybe the first question to ask is, what is intoo?
Sure, that's an easy one, big broad question. So as I said, so we're a commercial real estate investing platform. So essentially what that means for the user, i.e. retail investors, is that they now have access to what we have considered to be premium commercial grade real estate investments delivered directly to an online platform that they can access either through their mobile phone or through a desktop. And with a minimum investment of about $25,000, they can have a piece of a deal that has, for us, historically delivered a little bit under a 17% return on investment. That offers them, in most cases, two sources of income, because most of what we do is income generating. It offers them a cash on cash passive income every single quarter. And it also obviously offers them the yield at the end of what's traditionally a short-term investment, about 3 years, sometimes less. And so what our mandate is at intoo, and what it's been since 2015, and is founded by commercial real estate guys, quote unquote, is finding those opportunities that, through all the years of data we have access to, through looking at macroeconomic trends, geographical trends, are really designed to deliver the biggest bang for the buck. That's really what it's about. So sometimes these are going to be offerings that don't sound super sexy, like apartment buildings and senior living and student housing in cities that not every retail investor is familiar with, like Kerrville, Texas. But we are using, as much business intelligence and data as we can to come up with a model that says these are the offerings that are going to deliver those returns, because ultimately that's why retail investors are looking to accomplish with their investment dollars. So that's really, I think, the sort of long and short of it of what we do. And on any given month, as opposed to some other players in the category, you probably won't see more than 4 offerings at a time, and that's mostly because through that whole curation exercise that we do, we only really approve about 1% of the deals we see. And that's because it has to really fulfill a lot of different criteria in order to fit into our thesis.
Got it. No, I appreciate you kind of going through that, because it, the platform, while I guess the idea of being able to invest in real estate from your cell phone, I think traditionally people have thought that they had to buy the real estate, buy the property, unless they were participating in like a syndication or something like that. Is this a syndication type model? Is that what you guys are doing, or is this?
This is a great question. So I think you're absolutely right that, for anybody that is not an expert in commercial real estate investing, I think the perception is you either have to buy the property yourself and therefore have a lot of capital to do that. And I think we have a culture that's filled with television shows about flipping houses and using that as a mechanism to make additional money, or to be a job for that matter. Or you have to know somebody, right? You have to be connected to somebody in the business that is going to give you access to these kinds of opportunities. What our model is, and there are other players in the space, our offering is, and this is all as a result of a change in a law that was passed in 2012 called the Jobs Act, which basically allows companies like ourselves to offer individual, it's basically selling securities in an investment. We form an LLC in most cases, and you are investing in that LLC that is investing in that project. And so what it does is it takes this, I think, quite sought after and misunderstood asset class that was really traditionally in the purview of a few insiders with a lot of money to spend, and really widens the net for a traditional retail investor who could come in at a threshold of as little as $25,000 and say, I own a piece of an apartment building in, Louisville, Kentucky, which is our current offering. So I think it's about breaking down those barriers. I think you'll hear a lot of people say we're democratizing commercial real estate investing. But the structure is basically a security, and it's a security in a joint in a LLC that invests in the opportunity that we have.
Got it. And so, just to make sure I understand correctly, the investors are invested in a particular property, not just in a pool, a fund. Is that correct?
Right, so that's a great question, because we all know about REITs and we all know about other funds. So in most cases, we now have been diversifying a lot with the offerings we had as a response to what investors are looking for. So in most cases, if you look on our platform right now, we have 2 offerings. One is, as said, a project in Louisville, Kentucky, that just launched about 4 days ago. And we have a fund. Our fund is not, I think the word fund, I think people think blind pool. I don't really know what's in it. I put my money in and I hope for the best. Our fund is basically a way for an investor to, through one investment, minimum $30,000, hold a position where they're in at least 3 different offerings that are diversified both in project type and in geography. So we have some investors that don't want to be looking for individual investing opportunities every single week or month, but they believe in CRE and it has seen success. So they want to hold their position and they want to get instant diversification. So the fund fills that need. So you'll always see sort of a combination of individual offerings that are project-based, as you said, in combination with fund-like products that allow for a different kind of investor profile.
Got it. So if I'm investing in a particular property, I assume I'm in until the property is sold. Is that correct, or?
In most cases, that is absolutely correct. Our investment thesis is about relatively short-term windows. So our max is 36 months. And usually what happens, and I could tell you for the now 12 exits we've had so far, we usually get bought out by the developer. That's usually what happens. And so a lot of times we'll get asked, well, why don't you hold it for longer? Because a lot of people believe the longer you hold it, the more money you'll make. Right now, and again, we're very much trying to offer a certain kind of investment experience to a certain kind of class of investors who are really looking to either preserve capital or grow their money in a relatively short window. And so we very, very accurately look at the macroeconomic trends in in our country, what's going on, et cetera. And we feel that this 36-month window is right around the sweet spot of where you'll do really quite well and better than a lot of traditional asset classes. And there won't be you won't be as much at risk for the ebbs and flows of the market, in whether it's in the geography or in the project type, and you'll still be able to do as well as you can possibly do in that short term. There are other players in the space that offer more like 7 to 10 years or 5 to 7 years. This is where we are right now, and it's about offering a liquidity event in a short window.
Got it. Are you using debt? I mean, when people invest, are they investing as equity? Are they investing as debt, or are you getting debt in addition to that, or can you speak to that?
Yeah, sure. Great question. So until this moment in time, and actually things are changing as we speak, obviously, everything on the US platform is equity. So the traditional sort of construct is we have a partner, Meridian Capital, that usually supplies the debt. We usually take anywhere between 80 and 90% of the equity. And then we always make sure that the developers that we work with, which we vet very rigorously, also have skin in the game, and they're putting in, let's say, between whatever it is, 10 or 15%. So it's a triangulated model where we represent we in coordination with the sponsor have the equity. So we'll have a host of investors that come in at, anywhere, sometimes it's $25,000. Our average investment actually is closer to 100. And we've had investors come in at, millions in certain cases. And then we fund the equity portion in coordination with the sponsor. And then we have a debt partner. Now, as we evolve, and I'm sure we'll be talking a little bit about where this whole industry is going, we are looking at other offerings that might fall more into preferred debt, et cetera. They are not live on the platform at the moment, but if you keep on checking in with us, I bet you in the next 6 months, you'll see some diversity there.
Got it. You've mentioned some of the other players in the market, and when I was preparing for this, actually last night I was looking online. I read, and if I believe I read correctly, did intoo recently purchase RealtyShares? Was that the assets?
Correct. Yes. We made an announcement about a week ago, which is really, really exciting for us. RealtyShares, which was in the top 3 in our space, in the commercial real estate investing space, and made an announcement last fall that they were shuttering, and they were only going to continue to service their existing live investments, and would no longer be selling any new investments. And so when we heard that, there were several companies that were in conversations with them, and we're thrilled that intoo, in partnership with Reef, a developer in Texas, agreed to acquire the management and operation of RealtyShares assets. We formed a joint venture that's going to be responsible for servicing the existing remaining 300 investments. And then any new live investments that base of users is interested in investing in, they can come to intoo.com, and they will be, pre-credentialed to be able to have access to our offerings. So overnight, we go from relatively unknown global player to a much more known player in this space in the United States. And, it's our vision to really take a model that has really worked pretty well for us, to date, globally, and to leapfrog that growth with the access to these investors. Our community has now gone from about 50,000 investors to 200,000 investors with the acquisition of RealtyShares. So we're super excited.
No, congratulations. That's exciting news. Want to ask, and I don't know exactly, I'm trying to frame this, so bear with me for a second here as I try and mumble through this. But so I guess what I'm trying to get a feel for and see if you can speak to is that it sounds like the data mining or analyzing the data is really kind of the piece that you mentioned that's a real critical piece to determining the investments you guys or that intoo selects. And then I wanted to also kind of tie that with recognizing that historically real estate has been considered a fairly level producer. I mean, it's been, reliable, I guess maybe a better word. And it's this last 10 years or so where we went through this just cataclysmic market crash. And, the run up here in the last 10 years has really spawned a lot of new opportunities, including like what you mentioned, the Jobs Act, and how it's affected the opportunities for platforms similar to intoo and RealtyShares and that. I wonder if you can speak, or if you have any thoughts on, or if intoo has any positions on, just, and maybe it's more about the disruption of the marketplace. But it seems to me that one of the things that's created these dips and valleys, or valleys and peaks in the market has been the access to capital. Like if there's a lot of capital in the marketplace, then building goes nuts, and then when they've overbuilt, then there's a crash, and then there's no capital, and then it starts over again. I'm wondering if these platforms don't help kind of, I don't know, bring down the peaks, raise the valleys, or kind of make it more just a more regular source of capital. Does that make any sense, what I just said?
Yes. I mean, I'm going to try to address it, answer the question in a way that I think maybe simplifies it a little bit for me, again, being the newbie here, on what I'm hearing. Obviously, one of the major appeals of this form of investing is exactly what you said, which is that it has, over a long period of time, produced pretty well for investors. Before retail investors had access. So as you said, reliable, pretty steady and stable. And then of course we had the year that nobody wants to ever remember, and where everything went kind of ballistic, and not only in CRE, but in almost every single market, right?
Right.
When we think about data, and you want to say artificial intelligence or business intelligence, the way we use it is exactly what you said, was to identify those components or attributes that help to create a more stable set of criteria for a particular offer. So for example, you'll find that in our platform, we normally do not focus on markets where there's a lot of volatility from a CRE perspective. So obviously you're not going to see New York City. I mean, we've done outlying areas of New York City, but you're not going to see a big Manhattan skyscraper
Right.
on our offering sheet. So what we really try to look at is, we look at employment trends, we look at where do people want to live today? So I brought Kerrville, Texas up before, which I think is a really great example. It's a city that is growing, where there's more demand than supply for housing at the moment. And that's because it's within decent commuting distance to Austin, which we know is a growing tech hub. Young families are really looking to live in places that are less urban, more of a country-like setting, but still have access to tech jobs and the nightlife and the cultural life that in Austin is going to deliver. And so a place like that, from a more of a cultural perspective, is a perfect example of the model we are filling, which is the demand for affordable housing in a place like that where there's continued growth in the job market in the cities close to it is going to offer an investor a really stable, we think, and growing opportunity than a more saturated market like places in California, New York, Miami, etc. So where the data comes in is really to sort of, to your point, and I think you're right, is pull out some of the variability that might exist in the model and create a little bit more of a steady state where it is truly a more reliable form of investing. I'm hoping that answered your question, but that's kind of how I heard it.
No, I think so. I'm trying to determine, or I guess and this is kind of a thought that occurred to me as we're talking here, but it was more about, and you spoke to it, I think, but it's just that recognition of the combination of data, these disruptions in the marketplace, and the availability of capital. You know what I'm saying? I think that combined. I mean, if you have the data and you're able to, know what it is or recognize it's, what it's telling you. I think so many times there's been so much data collected that nobody really knows what it is, or they're not really mining it.
That's absolutely true.
But I think that's its own science, and sounds like that's something you guys are utilizing and finding ways to, dig through the data and find what are the tells that suggest or confirm why you're going in a certain place, and like you said, jobs and housing, and it does sound like at least what you mentioned there, that the millennials are starting to couple up and have kids and want to move to the suburbs as opposed to be, or at least within a reasonable distance to where they still have access to all of the urban stuff that they've come to love. And that's kind of like just an aging thing. I think if we look at historical models, I mean, in the suburbs, I don't think we're really, I mean, I'm not a historian, but if I remember correctly, it was kind of a World War II phenomena, post World War II phenomena, that all of the suburbs and that came online, which coincided with the baby boom and
Right.
all that. So, okay. So I appreciate you kind of, sharing with us a little bit about, intoo and kind of talking about that a little bit. I want to ask you, we've talked about I guess the platform and, the marketplace and, some of the reasons why, I guess we've kind of touched on benefits. If you want to touch on, some more benefits, please do. But I'm wondering, with everything, there's the untalked about, what are some potential downsides, or why would somebody not be interested in this or not want to do it? Is there anything to that you can speak to?
Yeah, I mean, listen, I think that part of trying to introduce an asset class that most traditional retail investors are not familiar with is the fear of the unknown. I think that as human beings, we tend to gravitate to what feels familiar, what feels in our control. And so for, I think, many investors in the US, and it's interesting, we don't see the same hesitation in other global markets that love US real estate opportunities. But in the US, we are really a more conservative bunch when it comes to where we put our money. And obviously, in our case, we're talking about accredited investors who are going to be by nature, older, right? 40s, 50s, 60s versus younger people who I think will continue to change the model. And so I think that the fear of the unknown and anything associated with said fear is going to contribute to hesitancy. I think in addition, any form of investing, it doesn't matter if you're investing in a building, in Bitcoin, in a mutual fund, comes with it some fear of some risk. I'm going to lose my money, or my money is not going to grow as much as I want. And what am I going to do about my retirement, etc. So those are the voices that I think, all hear in our heads, whether we're doing the traditional thing or when someone says to us, hey, did you ever think about doing something completely different? I think that what's going to happen over time, and listen, we've seen this in almost every single category. If you would have asked either one of us, and I'm assuming that we're about the same age or same generation, if someone would have said to you 15 years ago, you're going to rent a room in Miami from a platform where you're never going to meet the owner of the apartment, you're going to give them your credit card, and you're going to show up at some stranger's apartment, and that's how you're going to spend your vacation, you would have said, that's no way that's ever going to happen, right? And now Airbnb is booking more rooms than Hilton worldwide. So I think that we are in early days of behavior changing investment behavior, and we are trying to create models that remove as much as the discomfort and risk and fear that is normally associated with something new, and make investors feel confident and secure, and provide them with the same kind of user experience they get when they go online and do online banking or order a pair of glasses or anything else that they're doing these days. This is just another sort of disruptive behavior. And I think it's very much along the lines of a lot of things that we thought were impossible. And, Intoo, as well as some other players in the category, are really encouraged by this new class investors that is looking for that alternative. They want to do it differently.
Right. It's funny, you were kind of going down the model of disruption and how it's, affected so many different things in our lives. I'm wondering, could you walk us through the different people or the different touch points in an acquisition or whatever? I'm just trying to figure out, if I wanted to do this, is it all online? Is there any live chats? Is there somebody I talk with at all? Or is it all just go to the shopping cart or?
Right. No. So listen, we'd love a day. Believe me, it'd be great for our business if, people would feel comfortable not talking to anybody and just handing over large sums of money, but that's not going to happen. So our model, I think we use technology to create a good user experience and to communicate clearly and provide the level of transparency that investors are looking for. But to your point, and it's awesome that you asked for what's the touch points. That's exactly how we look at it. So, we do a variety of different marketing where people will end up at intoo.com one way or the other. They will register. And they will be put into a pool of people that are considered for us people that we are allowed to communicate with because they've signed up, right? Like a registrant. They will receive, almost before anything else, a welcome phone call with one of our investment specialists. So a lot of people will say, well, why would you ever ask for a phone number? No one's going to give you a phone number, too private. But we actually find that those people that provide a phone number are actually looking for what you just said, which is the high touch. They want to talk to a human being. They want to talk to somebody who has experience managing these kinds of investments, who could speak from a track record and say, I've done this kind of deal before, and this is what I've learned. I've worked with investors like yourself, and this is what they've learned. So we're finding that it's actually an interesting hybrid of old worlds and new worlds. So new worlds is where the tech and the data and the AI and the access to mobile will come in, and that's wonderful. And then the old world is we are in person, and so we are available by phone. From a geographic perspective, we often have investors visit us in our New York office. Obviously, we can't do that for investors that are in other parts of the country, but sometimes they want to do a phone call with a Zoom or a Skype so we could see faces. And at this point, we are a high touch experience. And so whatever that might mean today is what we're going to deliver, because ultimately, like I said earlier, it's about instilling a level of confidence in the investor so they could sleep at night knowing where their money is invested. And at the end of the day, nothing's going to substitute a human face and voice, right? So
Right.
That's what we've learned.
No, I appreciate you sharing that, because that's, there's so many things I'm comfortable doing now online, but if it comes down to making sure my money gets to the place where it's supposed to. And I think that, with all of the, cyber type stuff going on, that, it only makes sense that there'd be some sort of a reassurance and communication and high touch and that kind of stuff. That'd be good.
Absolutely.
And you mentioned, just to make sure I understand, you guys do you have boots on the ground in any of these places that you are investing, or how are you vetting these things? Is it solely data, or do you have people that are on the ground?
So that's a great question. We have a business development team that's basically there to source, review, vet, and sign on deals. And so there are 2 people based in New York, and we have a whole team at our headquarters in Israel, as I said. And part of the process is going to the sites and meeting the sponsors and going through a pretty rigorous checklist, both in terms of the sponsor's experience with the project that they're looking to fund, as well as with the asset type. Is it a multifamily? Is it a senior living, et cetera? So we're looking for proven track records, both in terms of the type of project as well as the geography. Hiring crews in a suburb of Texas is going to be different than in a suburb of Kentucky or Louisiana. So these are things that are part of that vetting process. There will usually be multiple meetings with sponsors at site pre-offering. And then once the offer is live on the platform, we're in constant contact with the sponsor. Sometimes that does involve subsequent meetings. Sometimes it doesn't. It depends. And then we are obviously delivering quarterly reports to our investors based on the progress of the project. So it's a really, it's a hands-on, and again, old school, put on a hard hat if you have to, kind of experience where using the web and sourcing of deals through technological means is only one piece of the puzzle. But again, that's not enough in order to ensure that the sponsor that we want to work with is ideal for the project. And so that's going to absolutely involve, if not several, more than several regular visits.
Got it. You've mentioned developer a number of times, and it just occurred to me: are most of the deals you're investing in, are they new construction?
So we've done both new construction and what we'll call value add. We find that the appetite of our current class of investors is more for value add, or what we'll call income generating, because of the ability for it to deliver 2 sources of return. So one is your cash on cash distribution every quarter, which is really nice for people to get a source of passive income. And then the ability to be able to guarantee a healthy return at the end. We have done, brand new construction. Those are usually longer term deals, so it doesn't fit perfectly into our investment thesis, but we've done them before and we are open to them if the math makes sense. But I think if you look at the platform at our most recent exits and deals that we're introducing, they usually fall into the income generating category.
Got it. Another question that occurred to me is, is if I'm a prospective investor and intoo, and the as these things go, I guess my question is this: how does intoo protect itself from just investing in deals just to do deals?
So you're saying, quality versus quantity?
Yeah, I think that's probably it. Because I think sometimes I've heard of, and I think that there's a deal frenzy kind of a
Yes.
mindset that happens, and all of a sudden people have all this money and they've got investors that are expecting return, and they've got to put the money to work, and how, I guess the question is that I mean, and maybe you've answered it already based on talking about the data and that, but I would think that that's, somebody would ask that of you at some point.
Right. So, I mean, listen, I think it depends on what your model is. There are models out there for investors that I think want to be way more hands-on. And I'm sure you're familiar with the type of, someone who I think of the day traders of the early, late 90s, right? When all of a sudden it was possible for somebody in their basement to day trade and make a living that way. Those are people that are going to go very deep and become very expert very quickly. There are platforms out there that really appeal to that mindset where the burden of research and curation and ultimately choosing the investment you're gonna put your money in is on the investor. So that means that they have to be able to have the time and resources, and I think to a certain degree, like aptitude to truly understand, well, of the 30 deals I'm looking at, which is the one for me, right? Our target audience is different. We are looking for the very busy doctor, lawyer, accountant who has a very, very, has a lot of time commitments and has a certain amount of money that they are looking for a new way to make work for them, and don't want to become a commercial real estate expert. They don't
Right.
want to sift through multiple tombstones to figure out which is best for me. They want that kind of done for them. So it's a little bit more of a concierge level approach. And hence why the volume will never be super high, because there are not enough deals that fit that criteria to make it on. To your point, I think you're right. There has been deal frenzy, and we see it and hear it, and we get a lot of these calls. From developers and sponsors that want to work with us, where ultimately, they don't get past the third question because it doesn't fit into the thesis. Now, that I think it's great if you have the time to become an expert and to really understand how this works. I think for that kind of investor, being able to sort of be in charge that way, empowered that way, is wonderful. But we're really talking to a different kind of mindset, and that's really where our model is right now, and I don't think that's going to change. That really is part of the DNA of the company, and although I think we may diversify more in terms of the products we offer, the kinds of investments we offer, I think the idea of the thesis of us being hands-on and vetting is going to stay.
No, that's good. I wonder, can you share a recent example of a property? I know you mentioned the one that you've got in was it Louisville, or you mentioned Kentucky. Is there one that you can take us through from beginning to end? Because it sounds like you've disposed of a few as well.
Yeah, I mean, I have one. There's one. There's always the legendary stories
Right.
in 4 years. There's one great example, I think, that brings to mind sort of the potential volatility even in a vetted deal. We had a investment in it in a suburb in Georgia, outside of Atlanta. It was, I believe, student housing. And what happened was, which nobody could plan for, is the developer passed away in his young 40s. Sorry, I don't mean to get morbid on you.
Wow.
He just passed away. And, listen, as these things go, under normal circumstances, the bank is going to come in and they are going to foreclose on the project, right? So we sent a team of people out to Georgia and we spent, I think, about 4 to 6 weeks on site to try to replace this developer and sign a new deal. That sounds like a little bit, a high cost, for something like this. But I think that for us, and it was early in our tenure, it was really important that the economics of the deal that we signed before this tragedy occurred were really still sound. So the deal was worth saving. And we know that our investors saw that as well. And so in a matter of a few weeks, we were able to find a new sponsor, signed a new deal. And at the end of the 3-year period, the developer bought us out, and I think the return was in the low 20s, which is probably on the high side. So I think what you're seeing in this example is a couple things. One is, as you said earlier, and we've talked a lot about the data that goes into the actual selection process. But it can't end there. That's where the human touch comes in, which is you can't plan for everything. You can't plan for every eventuality, even if you have a rigorous validation process. You can't plan for somebody, one day, a tragedy happens. So what are you going to do then? And I think that, what we're really looking to do, and I hear my salespeople speaking every day, is combine that old world, handshake, investment kind of experience where the person, you look in their eyes with all of the innovation that the technology delivers from a user experience perspective. But, we're ready to do what needs to get done. And we know that at the end of the day, we're dealing with human beings. And so, sometimes that means that we have to be there, and that's okay.
Yeah. Thanks for sharing that. That's definitely something kind of left field as far as something you would not expect. So, but glad to hear you guys made it through and successful investment there. Shoshana, if we could, I'd love to shift gears here. As I mentioned to you before we started the call, by day, I'm an insurance broker, and in that we deal with risk management. And there's essentially three strategies we look at with our clients. And the first would be A, we avoid the risk. B, we can minimize the risk. Or C, we can transfer the risk. And that's when insurance comes into play, when you can transfer the risk. And so I've been asking all my guests, and I'd love to get your input. If you could take a look at, what intoo is doing and how it's working with investors, and answer the question, what do you see is the biggest risk?
So, I think we've touched on it throughout this whole conversation. I think that 2008 for people looms very, very large. I think that we're in this phase where all the numbers, like the sort of KPIs of our economy, are looking pretty positive, right? And we know from lots of prior experience, again, going to pick on our age again, sorry about that, that everything's cyclical. And, there's a new administration, or there's not a new administration, or there's a world event, or there's changes in the job market, unemployment, interest rates, et cetera. All of these factors we know from experience, have the ability to create pretty seismic shifts in investment markets across the board. We know this. And so although there's a book called Irrational Exuberance, that we're in this phase where, although we want to feel really excited about how everything looks right now, there is an American reality, which is we're always waiting for the other shoe to drop. And that's because for many of us, we've seen the other shoe drop and we've paid that price. Myself, I've been in the internet space since 1997. I've survived 3 bubbles and bursts in that time, 2000, after 9/11, 2008. I don't think anybody would ever bet that it's not going to happen again, no matter how good things look. So I think that, risk is something that is inherent in this business. I think it could come from a variety of different places. I think that what we need to do we call ourselves a direct to investor platform. So we're not a JP Morgan Chase or a sort of big institutional company that is not going to come across individual investors that we know and shake their hands and have a relationship with. We can't afford to be that disconnected. So what we try to do is, and we've done this in the short time we've been around, is really like pull apart, where does risk sit? What are people most worried about? And so I shared with you the data that we use. I shared with you the fact that we stay actively involved in the investment. I shared the fact that we have a thesis that says these are short-term investments where volatility in the market is minimized. And we recently, about 6 months ago, actually introduced a pretty revolutionary product where we actually provide equity protection on principals for certain ones of our investments. So it's a double layer of protection, excuse me. First layer is you, as part of your investment, a small piece of it goes into a retention fund, like a social pool. And then when that's exhausted, if an investment does not go well, which has not happened yet, not would, then the second layer, and I'm sure that this will appeal to you as an insurance guy, is we have a reinsurance policy with one of the largest reinsurance companies called Everest Re, that is there to provide that second layer of protection. Now, this protection is not on every one of our investments, because as you probably can imagine, the projected returns on an insured principal are going to be lower than on one that's not, no pain, no gain, high risk, high reward, etc. And so, but I think that, when my CEO, Eran Roth, walked into Everest Re probably about a year and a half ago to say that he had this idea that we should insure people's investment, everyone thought he was crazy. But if you think about it, we insure almost everything else, our lives, our homes. There's vacation insurance, there's weather insurance. Why not insure your principal on an investment? And so again, I think we're looking to really think about what are the things people are most scared about from a risk perspective and find ways to mitigate them. And sometimes that is in the form of a policy. Sometimes it's in the form of a model, like the way we do our business. Sometimes it's showing up in Georgia and making sure that an investment continues to stay on track. It depends what it is.
No, I appreciate that, all that. Insuring the contractor, that's an interesting concept. And as those types of products go, I'm certain that if that's, if the market wants that would probably be something that continues to grow. And it certainly would make sense from a standpoint of an investor, wanting that. But like you mentioned, that the cost and the lessen the return rate there a little bit, but still interesting.
Yeah.
Shoshana, where can the listeners go if they would like to learn more and connect with you?
Sure. If you want to connect with Intoo, it's iintoo.com, intoo.com. You could even do Google search. And we have, once you register, then you'll be able to view all of our live investments. And we also have, there's a toll-free number on every single page of our website, as well as an email address that I actually personally answer. So if you have any questions, invest@intoo.com, and it'll either be myself or our head of investor relations. And, any questions about the business and any opportunities, what your investment needs are, we're here to answer your calls and emails and hopefully connect you to the next great opportunity.
All right. Shoshana, I can't say thanks enough for taking the time. I've enjoyed talking, I've learned a lot, and hope we can do it again soon.
Thank you so much. This has been so much fun.
All right. And for our listeners, if you like this episode, don't forget to like, share, and subscribe. Remember, the more you know, the more you grow. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.